Hello and welcome to this week's market analysis.
Latest news.
On the tariff front, due to the frustration with the pace of trade deal talks with the EU, President Trump threatened on Friday to raise the tariff rate to 50% as soon as the 1st of June. However, after a call with the European Commission chief Ursula von der Leyen, he did finally announce that he would be pushing back his deadline to the 9th of July, hence giving more time for trade deals to occur. On the Ukraine-Russia front, posting on Truth Social, President Trump wrote that President Vladimir Putin has gone absolutely crazy. This comes after Russia conducted the biggest aerial assault in a single night since the beginning of the conflict in February of 2022, and is a rather strong change of sentiment coming from the US administration to the Russian administration. Of course, this therefore means that the potential for a ceasefire and/or peace deal does appear to be further away than before.
Weather.
Looking at the temperature forecast anomaly, we can expect some heat wave looking at the 1 to 3 day forecast all the way until the 7 to 10 day forecast, especially in the Iberian Peninsula. When looking at the precipitation forecast, we can expect some rain in the 4 to 6 day forecast in the Balkan region and some rain scattered across Eastern Europe and the UK in the 7 to 10 day forecast. Looking at wind speeds and therefore potential wind generation, we can expect some relatively strong generation in the UK in the next 1 to 3 days, but some relatively muted wind generation after that.
Macroeconomics.
Quickly mentioning some macroeconomic information, the UK did publish their April year-on-year inflation rate that came in at 0.9% above the previous value. This was mainly due to energy prices, which reflect the rise in the off-gen energy price cap, which has been introduced now.
Crude oil and LPG.
Looking at oil price evolution for both WTI and Brent, we can clearly see a relatively sideways price evolution on the week. However, look at the past 12 weeks, we did see a relatively bullish trend there. A bearish trend, excuse me. But on the bullish side of things, the prospects of further US sanctions on Russian oil after the deadly attack, the missile attack on Ukraine that was launched by Russia throughout the weekend, increase the possibility of further US sanctions on Russian oil. Furthermore, media did report that the US government had received intelligence indicating a potential attack by Israel on Iranian nuclear facilities. This, however, did not happen so far. Furthermore, the delaying of the 50% tariffs on the EU also had an impact on the market. However, on the more bearish side of things as well, we did see OPEC Plus will meet on June 1st in order to discuss their July output. It is quite clear, and rumor has it, that they will continue pumping more oil into the market, which has been the trend in the past few years, which of course would be a bearish factor on global oil prices.
Natural gas.
Moving along to the gas price evolution, as you can see in the previous week, we did see increases of 3.3% on the calendar 26 product and slightly less on the calendar 27, 8, and 29 products as well. As you can clearly see, in the past week and 4 week is where we saw the biggest increases. However, if we look at the past 12-week percentage change, we still do see a bearish trend. Looking at storage inventory levels, we are now very close to the 2022 levels. And actually, when we look at the spread between this year's gas storage levels and last year's levels, after a strong rebound towards the end of April, we have now, I would say, flattened out the curve. The reason for this is due to the decrease in net injections that we have seen in the past 2 weeks. As you can clearly tell, at the end of April, beginning of May, we did have much more net injections compared to 2024, and this was due to the very strong cold spell that we experienced during 2024. The reason for the slight decrease in net injection rate can be attributed simply to a lower supply of gas, which you can see in the graph on the left. Now, why was there a lower total supply of gas. First off, this can be answered when looking at the Norwegian gas flows. Throughout the year, a normal steady supply usually is at a level of 330 million cubic meters per day. However, as you can see towards the end of this graph, we saw quite significant decreases there. This was due to mainly planned outages due to maintenance issues. However, there were also some unplanned outages and also some delays in the reopening of these gas fields, which caused prices to be further bullish. This can be seen in the top left graph in the Norway plus UK graph, where we do see a decrease there of gas supply. Furthermore, and the second reason why we have received less total supply has been the decrease in LNG European imports. This is also very important, of course, because as we head into the summer, we will be competing against Asia for LNG supplies, and therefore the higher European gas prices go, the more attractive it is for LNG to flow into or to be sold into Europe, and that would increase gas storage levels more significantly in Europe, of course.
Coal.
Moving along to the coal price evolution, on the week we did see relative increases for all coal indexes. First off, of course, the reduced tariff rate between the US and China was an important factor here, alongside the potential replenishing of stocks ahead of the summer season. However, it is quite clear that the underlying fundamentals do remain bearish, with high stocks for most countries and relatively muted demand.
EU and UK emission allowances.
Looking at the carbon allowance price evolution, we do see quite some different price evolutions when comparing the EUA product and the UKA product. As you can see, it was much more of a bullish week for the UKA product, and even when we compare in the past 12 weeks, the UKA product was much more bullish. The reason for this is due to the rumors of the potential linkage between the EUA and the UKA, which has also helped reduce the spread between these two products. Furthermore, cooling demand throughout the summer will play a very important role, as if there's a high cooling demand and low renewable energy generation, fossil fuel generation will have to come into play, and therefore carbon allowance demand will also increase. Looking at investment fund positions, we clearly see a continued increase for UKA futures and a slight rebound for EUA futures.
Electricity.
Now, moving along to the electricity price evolution, looking at Germany in particular, we did see a relatively sideways trend, with calendar 26 prices increasing by 0.69%. We can also see the trend for other countries on the left-hand side and the Nordic prices on the right-hand side, which have quite clearly rebounded, mainly due to the drier forecast expected there and the low snow cover as well, which caused Nordic system prices to increase quite strongly in the past few weeks. Nuclear generation, after starting the year quite strongly, has decreased due to some nuclear outages, especially when we're looking at the French nuclear generation on the right-hand side. We are still quite a bit below the REMIT forecast curve there. Looking at renewable energy generation, we are now at quite a satisfactory level and actually a little bit above where we were in 2024, which has therefore caused fossil fuel generation on the graph at the bottom there to actually be lower than where we were in previous year. This is mainly due to the uptick in wind generation that you can see at the top left graph there, and the continued strong solar generation year on year that we're seeing for solar there. So clearly, when we put wind and solar together, we are quite a bit above where we were in previous years. Because of this, overall fossil fuel generation has been or is relatively weak. Looking at fossil gas generation, we are towards the end or at the bottom, very close to where we were in 2024, and coal generation has also been quite low and below where we were last year at this point in time. Looking at hydro reservoir levels, I would like to highlight Norway and Sweden that had extremely high hydro reservoir levels so far throughout the year. However, as you can tell, The increase that was seen last year so far has not materialized this year, and there are expectations that actually hydro reservoir levels for these two countries will be at a deficit compared to previous years soon. Again, mainly due to the dry forecasted, so not a lot of precipitation, and the low snow cover as well. And to finish off, when looking at the guarantees of origin price evolution, overall last week we actually finally saw a very strong bullish trend, an increase after quite reduced prices, especially when looking at 2026 all the way to 2028. And this was mainly due to the low hydro expectations and really a estimate that changed in the previous few weeks after very strong hydro data that we had recorded in Q1 of 2025. Thank you very much for listening to our weekly market presentation, and we wish you all a very nice week.